It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Monday, the final Ask Mike Monday of the year. I'm Paul Peebles, national underwriter for Old Capital. Of course, we have the man himself, the mayor of the great state of Texas, or the governor, as I would like to say too, Mr. Michael Becker. Michael, how are you?
All things are going pretty good. Getting ready for Christmas as we record this. Is just right around the corner. So looking forward to 2026.
Yeah, 2026 is going to be a big year in multifamily, and we'll talk a little bit about that to kind of figure out really what people's game plan is for investing, whether it's stocks, bonds, or cash. Don't forget that multifamily, there's some tax implications that you want to consider if investing in multifamily, but also too, as you're buying a hard asset. So we'll talk a little bit about how 2025 was and 2026, what the prognostication thinks of next year. So again, if you're thinking about getting into multifamily, don't forget to the Old Capital bus tour coming in January 16th. Go to oldcapitalpodcast.com, oldcapitalpodcast.com to join us to be on the bus. We'll have 50, 60 people on the bus. So we're going to go over around North Texas. So if you're not familiar with North Texas, this is kind of your first step to think about getting and investing in multifamily. And what it does is that we'll do some classrooms for the first couple hours and then get you actually on a bus. And we'll drive to properties that are currently either for sale or we financed. So we'll get you off the bus, and then you'll walk around and maybe talk with a listing agent, talk with some bankers, talk with people that are in the industry so you can check the box of that you actually were in Texas, that you looked at some properties, and that you've developed a passion to invest in multifamily, if that's something you want to do in 2026. So come to Old Capital Bus Tour, but RSVP to the oldcapitalpodcast.com, and we will see you January 16th. 2025 is almost in the books, Michael Becker, and let's talk a little bit about just what you're thinking, what you're feeling of 2026. So maybe you can kind of give us an overview of what you thought of 2025, and then we'll get into 2026.
Yeah, it was a tale of two cities, right? I mean, it was operationally was still pretty challenged to be blunt. I mean, we saw some green shoots, and there's certainly some headwinds as well. Going into the year, I thought for sure up in Dallas-Fort Worth, as we kind of get into the spring leasing season, called March, April of 2025, I thought we'd see, some level of rent growth, and we got there. Everyone kind of, myself and pretty much the whole market started trying to push rents, and everyone had that for a couple, 3 months, and just really didn't stick. And then concessions and rents fell, and kind of had to backtrack. So everyone's really focused on occupancy over kind of pushing revenue. They just really want to make sure they had the heads in bed strategy was kind of the approach. And then down in Central Texas, San Antonio fared a little better than Austin, but Austin was pretty tough year with, rent cuts and concessions. And as the market's trying to absorb the kind of final wave of deliveries that really kind of were crashing on the shores in 2025, and hopefully will be done in the first half of 2026, and then should see fundamentals kind of firm up. So thought we'd see a little more rent growth than we did, especially up in North Texas, and that just really wasn't the case. And then, it's been a pretty disparate market too, Paul, where it seems like Class A is generally doing better than the Class C workforce housing, and the B is kind of in the middle from an operational standpoint. I mean, I think you saw Trump came in, and his, immigration policies, for good or for bad, have been kind of impactful, especially on the lowest property grade, where that tends to be a little bit more where the illegal migrants would tend to be. So I think you saw pockets of multifamily where they would have, historically been 95 to 100% occupied at all times, kind of drop in the 80s. And there's people that either got deported or self-deported, and it was just like a drag on that segment of the marketplace. And I think I didn't quite fully anticipate how impactful that would be. We don't really own any of that, so it really wasn't like something I've had to deal with per se. But over the marketplace, I think you probably saw that in a lot of the deals that you're looking at potentially financing or refinancing, Paul. So that was kind of certainly a big narrative. And then on the kind of the good news front is we have seen some moderation in a lot of the increases of materials and operating costs. And then actually seen improvement on property taxes. So, 24 is probably, flat to maybe slightly down on average from 2023. Everything's a little bit disparate in Texas. So depending on the deal in the submarket and et cetera, so we had some modest increases, but most of our deals for 2024 that we settled in 2024 taxes that we settled this year in 2025 went down. And then the handful of 2025s, which will basically settle next year, we definitely expect a further decrease in property taxes. So starting to really see that. And then 2026 is probably, flat from 25 or maybe down again. But 25 or 26 is probably the floor in value for assessed values for taxes. So probably have a little more tailwinds when it comes to, getting some savings on the expense side. The other big kind of industry news was the traveling HFCs. That was a big headline this year. A lot of noise. And then when the HB 21 got passed, and I believe that was April, kind of put an end to all of that. And there's going to be still a lot of shakeout that hasn't. You're starting to see some deals kind of be forced to be sold or given back or whatever. That magic pill isn't gonna save the deal. So there's still probably more of that to kind of play out. So I think we see a lot of that kind of come to head in 2026. So and then also in 2025, I think we saw a little bit increase in some volume, starting to see some deals kind of get unstuck. There's certainly some Class A deals that have traded, and then quite a bit more workforce housing deals have traded where the owner is kind of at the end of the rope and they can, clear their debt. And those have kind of traded. And then some where the bank has provided, some high leverage, attractive financing to try to get sold at their debt basis or higher. So you've seen quite a few of those deals kind of trade. And then I think there'll be, even some more wave of deals coming in 2026. I think the floodgates are starting to open up, and we'll see a lot of these deals kind of clear at the market clearing price. And, it probably bleeds into 27 to some extent in the workforce housing space. And then we can, start to recover again from a value standpoint. So just threw a lot at you, Paul, but those are some of the themes I saw this year.
Yeah, some interesting takeaways from the market itself. And I don't remember, Michael and SPI, they're operators, buyers, sellers of multifamily properties. I mean, how many properties do you guys own right now? And are you buying? Are you selling? A little bit of both. So first of all, how many properties do you guys own?
I think it's like 34, 35 properties right now, about 9,000 units, give or take. So yes, we're
mostly what areas do you guys buy?
Dallas-Fort Worth, Austin, San Antonio is kind of where we own. So probably 2/3 up in Dallas-Fort Worth, about a third in Central Texas, roughly speaking.
Okay. And did you guys buy properties in 2025?
Yeah, this year we bought 4, and then we had one deal that should have happened that's going to get kicked into Q1 for a variety of reasons. So yeah, we ended up buying 2017 vintage deal, a 2010, 2016 kind of two-phased A- deal, and then we bought a 1980s deal, and we bought a 2002 vintage deal. So kind of all over the spectrum. And then we're in escrow to buy a brand new construction deal from the developer. That'll be a Q1 transaction that's upcoming. So all had various degrees of distress with them, whether it's a capital distress. Well, take that back. All but one of them had varying degrees of like kind of the operational stress or capital stress. Or there's a story with every deal, and certainly 2025 was a story year, and I think 2026 will also be a story year for the most part.
We just pick out maybe one property that you guys bought in Fort Worth, good sized property. Tell us a little bit about, say, that deal and how that came to you. Did you guys go through a broker to buy it? Was it an off-market deal? Tell us a little bit more about that deal.
Yeah, we really hadn't been buying workforce housing for a while, right? I mean, if you go back, we've been doing this podcast for, a decade. And you go back several years, in 2017, 2018, you'd hear me say things how it didn't make sense to pay the same or similar cap rate for something built in the 70s or 80s that you could for something that's kind of brand new. And so it just hadn't made any sense to pay similar cap rates. And that's where kind of the market went to at the peak. Well, now you see the market kind of, get back in a little bit more normal state where there's a higher cap rate for the older vintage deals. And the guy that we ended up buying a 300 plus unit deal in Southwest Fort Worth, it was a marketed deal, and it came out with whatever guidance. And then, there's the go through the marketing process, and then all of a sudden the deal started missing on pricing. So it got a little cheaper and started making a little bit more sense. So we ended up getting a deal. I think the seller was in it for around 45 million, and we ended up closing around 31 million. So basically, he just marginally cleared his debt, and he had an equity partner that's forcing the sale, and there was just time to go. So it was just a attractive deal that was basically fully renovated. We have some money set aside to do, a paint job in a couple of years and some other stuff to the property, but most of the units have been upgraded from the interior, and the amenity set was upgraded over in the recent past. And it's one of the nicer deals in the submarket. And, where our basis is we're probably 35-40% below a lot of the comps in there from what their current owners' basis are. So the rent level that we need to achieve to make profitability compared to where they need to be to make profitability is substantially different. So, I'm going to be in a very much a competitive advantage where, just my basis is just lower, and I can cut all my competitors' throats with the rate to take the best quality tenants, and then they'll kind of, clear those deals out, and then the market will recover. And I like my position pretty well. So it was just attractive basis. And the story usually starts with, hey, the seller's losing, most, if not all, their money. That's kind of usually the start of these workforce housing deals today. And if they don't have that story, these workforce housing deals don't tend to trade. And this is kind of on the higher end of that spectrum as well from a quality standpoint. And it's on a major thoroughfare, and we owned in the submarket and did well in the submarket several years ago with the property that we owned, and so felt it was a attractive entry point. So we pulled the trigger.
Did you guys do long-term Fannie Mae or Freddie Mac fixed rate on that, or did you do a bridge loan? I mean, what's attractive these days in your world for investors to consider to invest in?
Yeah, we ended up getting a 5-year loan, Paul, fixed Fannie Mae, and I don't have it exactly. It was somewhere around, I think 484 was the rate.
Wow.
We bought that down. So we paid a point and a quarter to buy it down, so it would have been a little bit north of 5. But that was we timed the treasury pretty well, and just the way it worked out was the summer the rates were higher, and by the time we closed in November, it was the treasury yields had come in, so our corresponding rate had come in as well. So it worked out reasonably well. So borrow money sub 5 and get mid to high 6 cap rate year one. That kind of positive leverage is back in the marketplace in general. So you kind of seen either these deals that are generally well occupied and operating decently trade at with positive leverage, or it's a per pound play where the deal's just a complete mess operationally, and you're just buying it really, really cheap, and then have to invest capital to turn around operations. So we did that on another deal, but it's just it's usually one or the other in the marketplace right now.
It is a unfair competitive world out there. Michael Becker has said in the past, and so you didn't have the highest price, but you had the commitment that people knew you in the market, that you guys could actually close on the deal. And do you think that was the reason why the seller chose you?
Yeah, but I think that's basically every deal we did this year that had some variety of that. In the first deal, I think there was a reasonably competitive qualified group there, but stacking, especially this workforce housing deal, stacking our profile up against the rest of the people on the bid sheet, we're clearly head and shoulders more accomplished and capable group that the perception in the marketplace is that they sell to a group like us, we'll get the deal done, where a lot of the other groups are unsure if they can raise the money or what actually close on the deal. So by certainty of execution when you got to close, you got a loan maturity, or whatever the reason is that you got to sell. If you have a must sell deal, certainly coming into play, and you're getting discounts for being a group of the profile that can actually close on these deals. So as I like to say, it's a completely unfair business, and that's one of the things that's a competitive advantage of a group that's been around doing transaction that's well known in the marketplace.
Talk a little bit about what SPI does, and again, Michael is with SPI. in that, trying to get the competitive advantage out there. That's what SPI does, because they kind of guarantee certainty to the seller that they are able to close. But they only can do it when there is investors with them. So they put a lot of money into these deals, but also too, they turn to their portfolio of other investors. And in fact, how many K1s this year do you think you're going to have, Michael? Any idea?
For the last tax season, I think we did about 2,200, 2,300 K1, something like that.
Wow. So if you want to get a K1 from Michael and his group over at SPI, what's the best way for people to get more information about how to maybe co-invest with you?
Yeah, the best way, just go to our website, which is spiadvisory.com. That's SPI, like spy advisory.com. There's a form you could get into our database and get our newsletter. I do a quarterly newsletter and learn of upcoming offerings, which we'll certainly have one in the first quarter. But speaking of that, I felt like pretty encouraged. We just did kind of basically 2 back-to-back raises for that Fort Worth deal, and another North Texas deal that we ended up buying. They were within basically a month of each other, and both closed this year. And both of them went really, really fast. To be honest with you, I was pleasantly surprised with the level of interest.
What does fast mean in your world, Michael?
These were on the smaller end, each of what we've done historically. I think they were in that kind of $6 to $7 million range each, which is a relatively small check of kind of what we had to do. We had a bunch of our own money in, and we had some a bunch of our own money in the deal, and then one of them we had one large investor that kind of put in about $3 million into a $10 million total raise. But anyway, so we were the first deal I think we got done basically in 7 business days. From opening it up to getting all the wires and all the paperwork in, we were basically soft committed, out of the gate. And then the second deal, I think it was 4 business days from taking our first subscription in to being complete, which was by far the quickest we've ever done it. And, I think it's people are starting to see the opportunity. We've seen the value reset. We have really good stories. Like, the seller's losing money, the values were way high and now they're quite a bit lower. We're seeing the supply, kind of going in 2026, kind of looking forward. Supplies, basically in the rearview mirror. So the deliveries are becoming much and much less. It's really about absorbing the deals that have been delivered. And then we should start seeing rent growth. What I thought we'd see in 25, I think it's market consensus that we see rent growth in 2026. Every, submarket and property would be slightly different from each other. But, the macro is that supplies in the rearview mirror, and we have, 3 maybe longer years ahead of us where it'll be, below historic averages and certainly below the recent crazy peak, but kind of like, we're going back to 2011, 2012 kind of delivery numbers in Dallas Fort Worth, which was, MSA that had, maybe 1.5 million, 1.6 million less people in that time period is kind of what we're going to start seeing for 26, 27, 28. So, the winds that have been in our face will kind of come into our back. We're seeing the big reset on property tax expense. We're seeing some cooling of the ever increasing other operating expenses that we've had. So we should start seeing NOIs grow, and these workforce deals are starting to see the people that bought in 21, 22 kind of get wiped out. If you bought on 21 on a bridge loan and you had till 24, you had an extension till 25, your lender's kind of you're at the end of the rope, and a lender's not allowing, not playing as nice in the sandbox anymore, and they want to get paid off. But there's still a ton of liquidity out there from the debt. You're starting to see the debt funds are loaning money. I mean, that's still pretty prevalent. Fannie and Freddie, I think, got an extra, was it 12 to 15 billion each, and capacity for 26 over 25. So the debt liquidity is certainly abundant. We've seen some rate cuts. Obviously Trump's going to replace Jay Powell in May, and so it seems like the Fed's going to be kind of dovish, and so maybe see some follow through, some more rate cuts. Who knows how that's going to translate to the 5 and 10 year Treasury? I'm not quite sure, but we're starting to see that, and we just need the equity to come back. The equity's been the hard part, and I was pretty encouraged with the pace and the interest level of these 2 deals that we just did, and we have, like I said, another one going to be coming up in January, February. That new construction, buying straight from the developers losing money on the deal. I've been in the deal 5 years, started from a piece of dirt to a beautiful apartment building and they're going to lose money and they got to go because they got a loan maturity and just one of those things. Again, not the high price bidder on it, just kind of the certainty of execution. So, there's that out there and there's a window of it. And I think 26 is open. And, I think the latter part of the year, that window gets, smaller and smaller. So we're going to try to do all we can to get as many of these opportunities on the board. And, I think 20 is the kind of the beginning of the recovery year. I think 27, 28 kind of accelerate and, probably be selling in 28 and 29 a bunch of these opportunities and hopefully, making a bunch of money. And then the deals that are in the portfolio should all kind of recover. And, Austin should see a recovery and turn around and see some rent growth. And I think that's like a powder keg ready to go up whenever we do see rent growth there. But until then, it's been a pretty stagnant market. So, reasonably optimistic, Paul, that we're going to see, both operational improvement as well as kind of value recovery on the Class A. I think the workforce, the values have been reset. I think we've seen some people actually recognize the reset. And I think that'll become now consensus in the marketplace. So you'll see a lot of these deals that haven't cleared finally clear, and then we'll see values recover. So it might be a 27 for recovery and value and workforce housing once all these deals finally actually clear.
We mentioned at the beginning of the podcast that really SPI in your group really is a niche regional buyer of properties, that you guys buy it in Dallas and Fort Worth, Austin, all the way down to San Antonio, so right down 35. How come you guys don't buy in Jacksonville, Florida, or Atlanta, or New Mexico, or Phoenix? How come you just never went into some of these other markets that maybe a lot of ownership groups have done in the past? I mean, tell me a little bit about what your thinking is. I mean, as a former banker, you got to know a lot of the people that had done that and maybe some of the repercussions that they found out when they spread themselves too thin.
Hey, it's not necessarily a wrong decision for going there, but it's just being a relatively small group. There's only so much capacity you have and, living and operating in the markets that we're in, and we're in pretty big markets. I mean, I think there's, between Austin and San Antonio, I think 550,000, maybe a little bit more market rate apartment units split between those two markets. And Dallas Fort Worth, I think we're pushing 1 million now. Market rate multifamily units, you have 1.5 million or more potential units that kind of fit in the box that we, potentially would look to buy. So for a group of our size, that's a lot of pitches to look at. If I was in a smaller market and I needed more pitches to look at, I think that would make sense to kind of leave home. But with the last couple of years as the exception, I mean, the long-term macro trend of Texas is, growth and population growth. And, we attract a lot of businesses and, I just don't see the Texas growth story stopping. We just have had a 2 to 3 year period where we got ahead of ourselves as an industry, delivering too many apartment units that coincided at the exact same time as we saw 500 basis points and interest rate hikes. So it's been kind of a tough, perfect storm that we've been living through the last few years. But, we've seen 175 basis points in the last 15 months of rate cuts. You're seeing the supply that was, generational, 50-year kind of generational high has now been by and large delivered. And we just got to, lease that up. And then the future supply behind it's going to be dramatically lower, especially in Central Texas and, quite a bit lower in North Texas as well. And then you're seeing, big needle moving corporate reloads, like in Dallas Fort Worth. We're seeing Goldman Sachs is building a massive headquarters that'll be open in about a year from now with, I think, 700 employees making 700,000 or more. There'll be office there. The second largest out of behind New York of any of their offices. That Y'all Street, the Texas Stock Exchange, is starting to get quite a bit of momentum. You're seeing a lot of nervousness. I just got back from New York here recently, and there's a lot of nervousness up in New York with Mondami getting elected and all his policies he's going to start implementing on January 1st. And right or wrong, it seems like a lot of the wealthy business decision makers are nervous about it. They're looking to go elsewhere, and Dallas is certainly one of the markets that's top of the list for financial services companies to add that incremental job. It's not going to be in New York City. It's going to be added in Texas or Florida or someplace like that, right? So I think there's just a lot of momentum and inertia, and we've been an apartment depression for basically 3 years now. They don't last forever. So there's going to be a backside of this. And that's what I would kind of preach. I think we're kind of at the beginning of the recovery in a lot of ways. And, might not feel like that if you're in the workforce housing space, but, the values are reset. The markets, I think, recognize the reset in the value. And now it's just time to clear. And once those deals kind of finally clear, with I think a lot of that will be cleared in 26, maybe some of it bleeds in 27. It started this year in 25. I think that, it's going to, someone's pain is going to be someone else's opportunity. And, you can come in at a much more attractive basis, a little, much more fundamentally sound basis and go in and have proper, underwritten expenses and start making money on the reset basis. So I think there's a lot of opportunity and it's hard if you're in some deal that maybe isn't, you lost some money on if you're a passive, but I think it's a good time to be buying. And those that are not been participated so far, I think it's a great entry point. I mean, it's going to be, this year, next year, the year after, these vintage deals are going to age really, really well. And I think everyone's set up to, the probability that you should make a lot of money is not, certainly a guarantee, but the wind should be at our back, and we should, these deals should age really well looking back in 2-3 years from now. And then these tax benefits that was a big help on raising money, Paul. 100% bonus appreciation is back, and with these resets and values and where the leverage is, I mean, these two deals we just did in the fourth quarter, it's a dollar for dollar or more in tax loss. So you invest $100,000, you're going to get $100,000, tax write-off. So if you can, get 70, 80 cents or more in a tax write-off to offset your other income, to the extent that you can write off other gains, I mean, it's just pretty powerful use of money. So it's, feels like we're kind of on the onset of being back. So I feel optimistic as we kind of go forward. And, I think we're kind of recovering.
If you're thinking about having a competitive advantage, you may want to talk with SPI and get on their database list so you can see legitimately what is going on. So if you want to put your big toe in the bathtub of investing slowly and kind of figure out if it's right for you. Again, Michael, what's the best way for them to contact SPI?
Yeah, just our website's spiadvisory.com. There's a button to learn how to get into our investor database and see our quarterly newsletter, which we do at the end of every quarter, and then kind of see these opportunities and at least kind of follow along and see kind of what's happening in real time. And if you're not ready, now there's always another deal, right? So there's opportunity, but I think it's a good time to get educated. So glad if you're listening this long in the podcast that you're here. And I know Paul and James do a lot of good content. James Ings has his own YouTube channel, which I don't think we promote ever on the podcast, which is great. Great information. He's a smart guy and puts out a lot of stuff. So he's kind of searched up James Ing on YouTube. I think that'd be a good thing to kind of subscribe to and follow, and join the bus tour. I think is a great thing. It's pretty affordable. I don't know what you charge, but certainly $100 or less or whatever you're charging. It's a nominal amount of money for the amount of education you're going to get and the people you're going to meet. And if you're pretty new, and this is a great way to kind of touch and feel. And it's one thing to hear what a C-class apartment or B-class apartment looks like, or what it is, but to actually go see it and feel it and kind of see the characteristics of it. That's very helpful when you're deciding, well, I want to invest in this type of deal or that type of deal, or whatever kind of is more comfortable for you and your investing and risk tolerance.
Yeah, absolutely. So some great information from Michael Becker at SPI. We certainly do appreciate Michael hanging out with us, kind of explaining a little bit more about what's going on in the operations and of multifamily in the Texas marketplace, and for you to get to know Michael a little bit better. So again, thank you, Michael Becker. Wishing you and your family a great Christmas and New Year's in 2025, and looking forward to 2026 coming up here shortly. Again, Michael, thank you. I'm Paul Peebles. Have a great day.